And I'll try and make this lecture quick so you can all go home. Obviously, it's going to be on the internet. So if you're watching it in a group, if you're watching it in a finance group or a mastermind group, well done. We're going to be talking about this to conclude, portfolio construction, monitoring in venture capital, and angel investing. So portfolio construction, and this is by Alex Graham. He's a VC and also a CFA. And he says that venture capital is a game of home runs, not averages. And the most important concept that we have to comprehend is this idea of home runs, not averages. So when we're putting together our portfolio, every single investment has to be a potential home run. He says that failed investments don't matter. I mean, I think it matters. But every investment you needs to have the potential to be a home run. And in terms of portfolio construction, 9 out of 10, 90% of startups will fail. And I think that this is what people don't necessarily realize, that you as a venture capitalist or even an angel investor needs the company to be more successful than the entrepreneur does. And I take it and invest $100,000 into 10 companies below. And I invest all of them, and this is just sort of an idea to give you an idea of portfolio construction, and I invest in all of them at a valuation of $1 million. And it takes 5 years for me to exit. And in those 5 years, 9 companies fail, as statistically we know that they would, right? 9 out of 10 companies fail. And only Red Arrow company succeeds. Let's clap for Red Arrow. So Red Arrow company, in just 5 years, gets acquired for $20 million. And the founders are ecstatic. They've only worked for 5 years, and they have a $20 million exit. Is that not better than working in a bank or working in a FMCG or whatever? They're millionaires. They can buy their house in Banana Island. They can go on holiday twice or 3 times a year if they want. And they have opportunities because now they're going back into the business world as second-time founders. That makes them more credible. That means that I now have 7% of the company that was acquired for $20 million. So 7% of $20 million is about 10% of $20 million is $2 million. So let's even say I was diluted down to 5% to make the math easy, right? Somehow due to lots of dilutions. I haven't done the full math of this, but I just want to put 5% because 5% is easier than 7%. So I get $1 million back. And then me and Mike Adenuga have to share 80-20, right? Because I'm the one that managed the money. And Mike is the one that gave me the money. And we've agreed to a 80-20 split. So that means that I give Mike 800K and I have 200K. Well, you gave me $1 million 5 years ago. So that means that the founders and the villa, probably now, both of the Red Arrow founders have collected CON or OFR. And, CON and OFR are in Nigeria titles of excellence given by the presidency. So those guys are doing good. They're chilling in Banana Island. They have their houses. Probably now they've relocated to Dubai or the UK or America. In fact, America has given them one of those visas for highly intelligent tech people. They've given one of those visas. Life is good for them. In fact, if you had just put it in Access Bank Eurobonds, which is now at 9%, you'd have made more money over the 5-year period with zero risk. So that's why when you're thinking about your portfolio, you as a VC need to do far better than the company that you're investing in. So this was a totally made up scenario, and I had to take the 7% down to 5% because I'm presenting, so it just makes it easier for me to calculate it that way. But you can see, and this is, a total mythical situation, right? But you can see how a entrepreneur can be happy with a certain outcome, but it's a terrible outcome for the VC. and an even more terrible outcome for the LP. Portfolio management. This is the last bit. And portfolio management describes the process investors use to analyze information, make decisions, and commit resources to improve or protect the value of their investments. And there are 4 components: portfolio management, company analysis, venture capital decision-making, and portfolio company assistance. A firm's ability to assist its portfolio companies is known as adding value. And this is what differentiates leading firms from the rest of the industry. So portfolio management activities can involve partner meetings, offsites, report analysis, board seats, financing, so organizing venture debt, introductions for subsequent fundraising. So I've been involved in the process of organizing subsequent fundraising for our portfolio companies. I've also been involved in the process of issuing venture debt to our portfolio companies. I sit on some of their boards as well. Guide them through exit transactions. So there was an exit transaction that one of our portfolios companies was going through that I was very involved in the negotiation. Hiring for them. So one of our portfolio companies just hired a CFO, and that was through an introduction. So that's a very important thing as well. Then strategic advice, business development, and crisis management. IPO, Jumia did this. They exited through IPO on the American Stock Exchange, I think on the New York Stock Exchange. The Computer Warehouse Group also exited through the Nigerian Stock Exchange. But what you have to think about when you're thinking about exiting through African stock exchanges is they typically have lower liquidity. You might not get your money back. Acquisition, this is the preferred path. This is the dream. And I told you about Paystack, one of the first companies we invested in. And that was acquired by an American company called Stripe, also in the payments business. And this is a preferred route due to speed, efficiency, and minimum regulation. IBM acquired 70 companies in 7 years, spending 14 billion. And it also pushed these products through their established sales force, and revenues, it grew IBM's revenues by almost 50%. Google has acquired 131 companies, an average of 10 companies per year. However, African markets have much smaller M&A locally. So we're always thinking about these liquidity events and exits and just thinking, you know, are we going to wait for a foreign exit, or are there more local opportunities? And I think that we'll be seeing a lot more local opportunities as time goes on. Types of acquisition, there can be a local acquirer here in Africa or here in Nigeria, and we've been through some of those before. It could be an acqui-hire, where they just hire the people and hire the company, and this usually happens at the earlier stage. Or it could be a strategic acquisition. Reasons why a company might get acquired. I think this is important to know because, you know, as a VC, you're also looking for people that might acquire some of your portfolio companies. So you need to know why a company would want to acquire. Increased revenue and profitability. Like I said, IBM made acquisitions that increased their revenue by 50%. That's massive, right, for a big company like IBM. Operational synergies. So if they're doing something, and I think Apple has done this, they want to start making their own chips rather than relying on chip making companies. So they've done a backward integration. So if it's part of their value chain and they want to integrate forward, or they want to integrate backwards, or horizontally, then that might be a reason, because there's some kind of operational synergy. And so I hope I've done these topics justice. We started off with definitions, if you remember. An introduction to angel investing and venture capital, the importance of a fund thesis, and we've gone on to more exciting stuff, deal sourcing, valuation, fintech, future of money, cryptocurrencies, due diligence, and all the peculiarities of the African market, the legal issues, and exits. But I'd like to conclude with the big picture about why we do what we do. I said in a slide on venture capital and the economy that venture-backed companies now represent 21% of American GDP. The only sector that is represented in Nigeria as much as VC-backed companies is agriculture. In terms of a contribution to GDP. Imagine the kind of value that we could create with these technology-enabled, technology-first companies. They will even add value to the agriculture. And that's why I find this sector and this work so rewarding and so exciting. And I hope I've made it rewarding listening to me talk about it, and exciting as well. Thank you very much. Good evening.